So the bond ETF industry really got going in 2002 when the first bond ETFs were launched by us. And I think there's probably no better way to explain why a cash bond investor should pay attention to this space than to show a couple of quick stats. The drop in bank balance sheet. Look at how sharp that red line is. From $250 billion of corporate bonds held overnight to 50. Look at the blue line. That's the amount outstanding of corporate bonds, going from 2 trillion to 6 trillion. The volume of cash bond trading in the secondary market grew by about 20% during the same time. So 20% versus 3x for the corporate bond market outstanding. So we know that cash bonds are trading less. One of our ETFs, US high yield, as a percentage of all cash bond trading. In 2007, 0. Today, 15% of all US high yield risk per day is exchanging hands through an ETF instead of cash bonds. And the interesting thing is the spikes there, which are all around stress events. Probably the #1 concern that the bond investors we talk to have for us about bond ETFs. If cash bonds aren't trading, how could a bond ETF possibly trade? Here's a couple of fundamental stats. The days before and after the Lehman downgrade, US high yield ETF traded about 11 basis points wide before, 30 basis points wide after. Now, that seems like a pretty bad jump, but it was still trading. Cash bonds were not trading a few days after Lehman default. US downgrade in 2011, that same ETF was trading 2 basis points wide before, 4 basis points wide after. And taper tantrum in 2013, 1 basis point wide before, 1 basis point wide after. And the volume went from 3 billion in the 10 days before to 6 billion in the 10 days after. So think about it. 10 days, $6 billion of US high yield exchanged hands, 1 basis point wide. Simply not possible in a cash bond market after a shock event. Everyone always worries, well, what happens if everybody's selling a bond ETF? Does everybody run for an exit? Remember, it's the same in a mutual fund. If everybody's selling a mutual fund, it has to sell cash bonds. So these bars, the blue is what bonds were sold out of our ETFs between May 1st, 2013 and June 30, 2013. The green is what was traded between investor A and investor B on exchange. Look at the ratio. I mean, it's not even comparable. All of that green was people selling. This was trading on the bid side, not on the offer side. So what we see during stress events, and almost every single day, is that a ratio of about 10 to 1 right now of bond ETF trading happens on exchange without a single bond transaction. And because it's happening on exchange, it means it's happening at exchange bid-ask spreads rather than OTC bond bid-ask spreads. So the left chart here is showing the price of one of our ETFs versus the NAV. And I keep referring to this period of 2013 because it was such a famous instability period in bond markets. You could also look at October 2014 when Bill Gross left PIMCO. You could look at a number of other periods, and you'll see the same stats. So you can see that the blue line is below the purple line. The ETF is trading at a discount. And there were a number of articles written around this time saying, see, bond ETFs don't work. But the NAV, remember, some of the bonds traded that day and we had a real price. And for the rest of them, we had to use marks from pricing services and broker-dealers. So what we did is we split the NAV into the part where we saw real trades and the part that we did not. And that's the chart on the right. The red line is all the bonds that comprise the NAV that actually traded on those days. Looks pretty accurate in terms of the bond ETF pricing, right? So the reality is when I talk to broker-dealer bond traders, they no longer look at the NAV of our ETFs. They take the price of our ETFs as an accurate reflection of what the average cash bond is worth, not the marks that they're getting. So when all of us, the cash bond investors, ask broker-dealers to give us a mark, it's probably a safe bet that they look at one of the ETFs see that it dropped 2%, and then they drop the average cash bond 2%.